everyone, and welcome back. You're watching The Money Show on ET. Now, it's time with our Spend with TMS segment. We have Diwali approaching, Dhanteras as well approaching, and I'm sure many of you, and yes, not to mention the wedding season approaching as well. I'm sure many of you have been mulling on different ways to buy gold, especially because of the way it has run up. And especially for those who are mulling, doing a wedding, maybe in a smaller fashion, it would, be interesting for you guys to really look at all these schemes that jewelers have come out with, monthly installments, the last installment is, paid up by the jeweler, etc., etc. So, should you be opting for those is really the question, that one should ask, especially as we approach this season where people do tend to buy gold. How does it really differ from any other installment scheme where, you keep paying your money on a monthly basis, like a recurring deposit, and you get a certain interest? So let's talk about this, how these schemes work, whether you should opt for them. We have with us, joining in on the show, Shweta Jain of Investography.com. Shweta, it's a pleasure having you with us. Thank you so much for taking out time for today's episode. So to start with, tell us, how do these jewelry schemes work? I know that different jewelry companies have a different concept of the scheme, but largely the overarching theme seems to be the same. So how do they essentially work? What are they offering the customer?
Thanks for having me on the show, Mubina. So basically, all of these schemes that we're talking about, where, one can buy gold jewelry at the end of usually a year. So you make payment for 11 months, and the 12th month payment is done by the jeweler. That's their sales pitch. And let me tell you, that sounds very, very attractive. Even I was sold on it for the first time when I heard about it. But when you go back and calculate, of course, I didn't invest before we go there. But when we go back and do the calculations, what looks like a great sales pitch isn't actually working that well for the customers due to various things. First, the return itself, if you see, isn't as attractive as it looks out to be. It's just that people like the word free. So that's why we tend to get sold on it. The making charges usually are quite high. Usually 10%, but it could go as high as 15 to 20%. The regulatory issues are another matter altogether, because that itself is a huge risk where we are opting for gold jewelry schemes. The purity of the jewelry is another issue as well, because a lot of these jewelry that we are going to purchase could be 18 karat, 22 karat. 22 karat is still good, but it could be 18 karat. And there are restrictions on the type of jewelry you could buy. So overall, I would not recommend these schemes because of all of these reasons.
So it's a no from Shweta on these schemes. And yes, even Shweta was very tempted when she first saw them. But then, of course, the devil is in the details and the fine print. And when you read into it, it perhaps may not be that attractive a proposition. How do these schemes, Shweta, essentially differ from something like, a bank recurring deposit? Because the concept is more or less the same, right? Where I will be putting in money every month so that I get a certain amount at the end of the year. So instead of giving it to the jeweler, wouldn't it be better that I put it in a recurring deposit, and then when I get the money back later, buy the jewelry of my choice?
Absolutely. I think that's a better way to buy jewelry. Start even a bank FD or RD. So if you start an RD, you invest, say, monthly. Even if you're doing 1,000 rupees, you end up investing, say, 12,000 rupees. At the end of the year, you earn an interest of about 400 rupees on this 1,200 rupees. If the interest, if you're getting about, say, 6% today. So if that is the case, how does it compare with, say, a jewelry scheme? So jewelry scheme, you could get approximately the same amount worth jewelry, but they will be making charges. So you could end up either losing 200 rupees in this example like I gave, or you could make maybe 200 rupees extra there, depending on what purity the jeweler has offered you. But like I said, it is looking very attractive, but it isn't the best of the schemes available. And I would definitely recommend for somebody who's looking at buying jewelry at the end of the year, start an RD rather than opting for one of these gold jewelry schemes.
Shweta, if somebody wants to buy these high ticket, gold pieces or jewelry pieces, this is how you would recommend via an RD?
Yeah, one could do an RD, one could do a liquid fund or an overnight fund because that itself, you get the liquidity, you get better returns. But an RD, like I said, it's the safest option there. The risks with the jeweler is also that, we have seen cases where jewelers haven't honored their commitments. People have lost money, so that itself is a big risk. In fact, regulatory wise, if you see, they have been compared to Ponzi schemes also, so that is one of the biggest risks that we overtake.
Exactly, Shweta. Actually, you touched upon the next point as well that I wanted to discuss. Last year, we had seen, Goodwin Jewelers. We had seen another small jeweler as well. They as well promised very high returns. We still have some small jewelers promising extremely high returns. If I'm not mistaken, Goodwin Jewelers offered 17%, and a lot of individuals were obviously very tempted at the prospect of earning 17% on an annual basis. So, what are the different forms these schemes essentially take, which, like you mentioned, almost look like a Ponzi scheme? What are the risks involved? And also, I'll just add one more question over there. Shweta. Do you think this risk is limited only to the smaller guys? Because you also have a Tanishq, very reputed brand. Even if somebody does want to go for it, wouldn't they? I'm sure you would recommend they rather go with a reputed brand like maybe a Tanishq or something.
Yeah, definitely. I think the risks are quite high when it comes to jewelers, and especially when it comes to smaller ones. And you rightly said, as high as 17 to 20%, we've seen small jewelers offer. But we have to ask ourselves this question: if something is looking too good to be true, is it too good to be true, or is it just good enough? So when it is 17 to 20%, I think rather than running towards the scheme, one has to run far, far away from that scheme. Because in the temptation of getting that 20%, you end up losing your 100% as well. So I would definitely say avoid the smaller jewelers. If you really do want to opt for this, there are a couple of ways that you can cut down on your risks. You can opt for bigger jewelers. You can look at Tanishq and, the likes of it. Divide. So, diversify across jewelers if that's something that you're looking to do. But like I said, it's always more flexibility when you invest it in an RD, because then you have choice and bargaining power to an extent at your advantage. Otherwise, you have to buy what options you get from that jeweler. You don't really have that freedom of choice. So why not exercise the freedom of choice if there is hardly any difference? Some of the schemes that they do share, maybe 11 months you pay, and the 12th month the jeweler will pay, or 60% of the final installment the jeweler will sort of write off. Things like that, or you have these attractive bonuses and things like that, saying you get this extra gift coin and things like that. So these are just ways to allure clients to this scheme. Whenever somebody is trying to sell me something, I just ask myself this question, and I think our investors should too. What's in it for them? If somebody is coming on quite strongly about a particular scheme, and we know how strongly gold jewelry schemes are being sort of pushed. So what's in it for them? If it's for our good, I don't think anybody will be pushing these products that hard. So I think that's something that we have to keep asking ourselves. One thing that people should definitely be careful about is making sure that each and every condition is documented. Each and every promise that has been made to them, whether it's of returns or whatever it is, everything is documented. Each and every investment is entered. Some of these guys even have passbooks and the like. So make sure everything is documented.
If it sounds too good to be true, it probably is. And Shweta does advise that, look, if you do have a high ticket jewelry purchase coming up, you know, you rather put the money in a bank recurring deposit, way more legal way to do so, in a liquid fund or any other short term duration fund, and then, you know, at the end of the year or whenever it's, you know, you're due to buy the jewelry, just sort of redeem that money and buy it. So that's the word, you know, coming in. Shweta, really appreciate you joining us with this guide of sorts for people's jewelry shopping this festive season. Thank you so much for joining in.